Good morning to Sir Syahril and everyone. Today our group going to present you about foreign exchange. There will be 6 subtopics under foreign exchange. The first subtopic is the importance of foreign exchange in international trade. The second one is the impact of foreign exchange rate movement to export proceed and import payment. Okay, the third one is way to mitigate foreign exchange risk in international trade. Fourth one is introduction to forex forward contract and forex option contract. Okay, the fifth one is to compute the forward rate. Okay, the last one or the sixth one is application of forward contract in international trade. Before we continue our presentation, I would like to introduce our team. Okay, we are from Team 15. My name is MAJID and my matrix number is 270246. This is my team member, which is ABDUL 269866, Nick Muhammad, AIZAT, HAIKAL 270790, ROSHIDEE 270514, No and SYAFIQAH 270318. For the next section, I will pass to other presenter to continue.
Assalamualaikum and hi to everyone. My name is MAJID bin JUNAIDIN. My matrix number is 269866. And today, I'm going to present about the importance of foreign exchange in the international trade. So guys, as you can see in the screen, this is the meaning of the foreign exchange market, where the agreement between the buyer and the seller, given amount of one currency is to be delivered at a specific rate for some other currency. As example, I am in Malaysia. I use Ringgit Malaysia RM and I want to buy goods from United States. So I will use US dollar to buy the goods. So I am in Malaysia as a buyer. I will use Ringgit Malaysia. I will enter this agreement between I, a buyer, and the seller in the US about currency, certain amount, let's say 100 US dollars. So I will purchase this 100 US dollars using the specific rate, such as that $1 equal to RM 4 ringgit. So I need for $100 that I need, the amount I need, say $100. So I need around 400 ringgit to buy this currency from the seller. So this is the meaning of this statement. So other statement in this slide is about the foreign exchange market. It's a form of exchange for the global decentralized trading of international currency. Yes, I want to buy in a global market. I don't mean in the local market. I want to buy in the global market, like such as like US. So I will use a US dollar. This is the meaning of international currency. So now I will touch about the importance of this foreign exchange. So the first important is to facilitate trade activities. Yes, if I want to do a trading activities, as I want to purchase a good from US, I will use this foreign exchange to do a trade activities, especially if it involves two countries that use a different currency. So another important thing is to maintain the economy stability. So as example, as know, Malaysia is very rich in the raw materials such as rubber, but US, the United States, don't have this raw material to build a car, in the factory of car, but they have a lot of technology. So Malaysia need this car, but also US need this rubber. So this international trade, I mean the foreign exchange, maintain the economic stability by doing the exchange of their goods between rubber and car using a foreign exchange. And lastly, the important to hygiene in the risk of loss. As we know, if we involve in the currency, is changed every second, every day, and every year. So this thing will make a risk of loss, or we call it as a exchange risk in the foreign exchange. So foreign exchange will make sure this thing doesn't happen using a forward contract between the buyer and seller that will into the contract that will lock this currency at that time. Example, I will lock this Ringgit Malaysia, 4 Ringgit Malaysia equal to $1 in January, and I want to buy from US at the March. So it involve a lot of time and the currency will be changed, right? So using the forward contract, the currency don't be changed. So don't be changed, even though in the 3 months later on it will be changed to $1 equal to 4 ringgit and 50 cent. So the 50 cent cannot be involved in this contract. So this will lower the risk of loss to the buyer, especially me in Malaysia, to buy a from US dollar. So that's all. So guys, what is the function? Function important is the similar thing but not the same thing. So the function of this foreign exchange is to transfer the purchasing power between countries. Purchasing power is how much goods or thing that you can buy using your money. So if purchasing power is too high from the country, the inflation will be high. So the function of foreign exchange is to transfer the purchasing power between the, let's say in US dollar, they have a lot of purchasing power but they don't have good they want to buy. So they want to buy a good from Malaysia because the quality or something like that. So they want to buy a bag from Malaysia. So US dollar will US country will transfer their purchasing power to Malaysia. So this will help Malaysia in economy. So economy, and also will help US in their economy too. Another thing is to provide a credit channel for foreign trading. Yes, this channel mean that a way how the way to do a foreign trading. So during using a foreign exchange, they can use a foreign trade because this is a good channel to do a credit, such as they want to buy a bill of exchange, bank draft, or other document that involve in credit of foreign exchange. And other thing, lastly, is to protect against a foreign exchange rate. Like I mentioned before in the hedging, the risk of loss. Yes, using the forward contract mean all the future, as we know as the future contract, we can protect against foreign exchange rate. So this will benefit to the buyer and also to the seller too. So we are in the player or party involved in this foreign exchange. So who are the player that involved in the foreign exchange? So the buyer and the seller is the party or the player that involved in this foreign exchange, because they want to buy or sell the foreign exchange. So from who they want to buy or sell their current exchange. So they will use a bank as an intermediary between the buyer and the seller. So the bank need to make sure that the demand and supply for the foreign exchange is stable, because the over demand or over supplies of the foreign exchange will affect the rate of the foreign exchange itself. So central bank need to make sure the interest rate that will then be charged to their customer is stable as according to the rate in the market, because the higher the interest rate that being charged, it will affect the rate. The higher the exchange rate. So when the exchange rate is higher, so the demand of the currency will be lower. So that's all for me. Thank you. I will pass to another presenter. I hope my explanation is well and being informative to all of the watcher. Thank you so much.
Now I will explain the impact of foreign exchange rate movement to export proceed and import payment. To explain this subtopic, I will give two examples or two scenarios. Okay, the first scenario is strong ringgit Malaysia. Okay, first we need to identify what causes this scenario to happen, which is the strong ringgit Malaysia. When there is additional demand on export, it will causes additional supply on USD. This will make the curve SOSO shift to the right side, which is to S1 curve. There will be excess supply at the point of EO or the original exchange rate, which is USD $1 equal to 4 ringgit Malaysia. The original exchange rate will tend to decrease until it reaches the new equilibrium, which is at the point of E1, where USD $1 equal to 3 ringgit Malaysia. This shows that ringgit Malaysia is becoming stronger or appreciating, while the USD is depreciating or become weaker. Since ringgit Malaysia is becoming stronger, it shows that it can buy more foreign currency than it could before. This also will increase the purchasing power of consumer. Why? Because they need a few ringgit of Malaysia to convert it to USD currency. Therefore, it will increase the import because there will be more demand on import since the USD currency is getting weaker. Okay, now we can see that when ringgit Malaysia becoming stronger, it will increase demand on import, but it will decrease demand on export. Okay, people who stay in United States will need a lot of USD currency to convert it to Malaysia ringgit currency. Therefore, they will be less interested in buying Malaysia item. This will cause less demand on import item from Malaysia. As a result, Malaysia will suffer a lot of loss from export. So we already see the impact of foreign exchange rate movement to export proceed and import payment in the scenario of strong ringgit Malaysia. Now we will discuss about the advantage and disadvantage when there is a strong ringgit Malaysia. Now we will talk about the advantage when there is a strong ringgit Malaysia. Okay, the first one is the foreign goods and service are cheaper to buy for the consumer Malaysia. Okay, the second point is the lower cost of imported goods contributed to the lower level of inflation. Okay, the third point is when Malaysia travel abroad, they will enjoy the benefits since ringgit Malaysia is strong because they need a few ringgit Malaysia currency to convert to USD currency. Okay, the last one will be there are lower price available for Malaysia investor to buy international stock or bond. Next, we will talk about the disadvantage when there is a strong ringgit Malaysia. Okay, the first point is the firm in Malaysia will have to compete with lower price import since ringgit is more expensive. Okay, the second point is Malaysia will become more expensive for the visitor from another country because they need a lot of foreign currency to convert to ringgit Malaysia. Okay. Lastly, in case of instability financial in Malaysia, it will be more difficult for foreign investors to supply capital fund. The second scenario or the next example is with ringgit Malaysia. First, we need to identify what causes with ringgit Malaysia scenario to happen. When there is additional demand on import, it will cause additional demand on USD. This will cause the demand curve, which is the DODO shift to the right side to D1 curve. Okay, there will be excess demand on USD at the original point exchange rate or point EO, where USD $1 equal to 3 ringgit. The original exchange rate will rise until it reaches a new equilibrium, which is at the point of E1 to form a new exchange rate, which is USD $1 equal to 3 ringgit and 50 cents. This shows that ringgit Malaysia is depreciating or become more weaker, while the USD dollar is appreciating or becoming more stronger. When ringgit Malaysia becoming more weaker, it shows that it need more ringgit Malaysia to buy foreign currency. Okay. This will decrease the consumer power because they need a lot of ringgit Malaysia to convert to USD. This will lead to decreasing demand or less interested to buy foreign item. As a result, Malaysia import will become less. Now we can see that when ringgit Malaysia become more weak, it will cause us less demand on import, but it will increase more demand on export. Why? Because people who stay in United States were interested to buy our Malaysian product. Why? Because people in United States will need a few amount of USD currency to convert it to ringgit Malaysia. This will cause more demand on Malaysia product and it will help to increase export Malaysia. So we can see already the impact of foreign exchange rate movement to export proceed and import payment when ringgit Malaysia becoming more weaker. Now we will discuss the advantage and disadvantage from that scenario. The advantage when there is a weak ringgit Malaysia is Malaysia enterprise find it simple to sell their goods in foreign market because the people in another state will need a few foreign currency to convert it to ringgit Malaysia. Therefore, they will be interested to buy our product since it is cheaper. Okay, the second point is Malaysia firm will face less competitive pressure to maintain price low. Okay, the third point is more foreign visitors can afford to visit Malaysia because our currency is become less expensive. So they will easily convert their currency to ringgit Malaysia. Okay. The last point is Malaysia capital market are becoming more acceptable to foreign investors since our currency is more cheaper. Lastly, I would like to talk about the disadvantage when there is a weak ringgit Malaysia. Okay, the first point is consumer confront higher prices for foreign item or services. Since ringgit Malaysia is becoming weaker, it shows that Malaysia consumer need a lot of ringgit Malaysia to convert it to USD currency or other foreign currency. Okay, the next point is greater prices for foreign product add to a higher cost of living. Okay, some product is not able in Malaysia. Okay, Malaysia consumer need to import those product from other country. So this will add more cost to their living costs. Okay, the third point is Malaysia visitors find it more expensive to travel abroad. Why? Because they need a lot of Malaysia currency to convert it to USD currency. Okay, lastly, it is more difficult for Malaysia enterprise and investor to grow into global market because those corporations need a lot of ringgit Malaysia to convert it to USD currency. So it is hard for them to enter into global market since Malaysia currency is weaker. Okay. That's all from me. Thank you for listening to my presentation. For the next section, I will pass to other presenter.
Assalamualaikum and hi, my name is SYAFIQAH and my metric number is 270318. I will explain on how to mitigate foreign exchange risks in international trade. First is by doing transaction in own currency. The companies who have a strong market advantage or a global brand may indeed be able to transact with only one currency. The exchange rates will be transferred to the local customer as the result of this method. It might be challenging because certain costs must be paid using local currency and it is achievable for business which are mainly conducted online. Next is by build protection into commercial relationship or contract. A long-term contracting companies such as oil and gas may have a significant foreign currency element. This may be reasonable to include foreign exchange clause in the agreement to allow revenue to be recovered if the exchange rate deviates by more than predetermined amount. And as the result of this, any foreign exchange risk is forwarded over to the customer or supplier. This can be massively effective approach of hedging against foreign exchange fluctuation, but it requires the adoption of legal language in the contract as well as the implementation of regular review regard by finance and commercial team. However, if this clause is triggered, it may lead to a difficult commercial discussion with your customer. The third method is natural foreign exchange hedging. When a firm can match a revenue and cost in foreign currency, the net exposure is reduced or eliminated. This is known as natural foreign exchange hedge. US company, for example, operating in Europe and making euro, will aim to get items from Europe to supply into its home US market to use this euro. When a firm owns business across various countries, this strategy will work well. The last is by using hedging arrangement via financial instrument. By using this, there are two primary methods, which is forward exchange contract and currency option. Forward exchange contract is a contract in which business agree to buy or sell a certain amount of foreign currency at a specific future date. The company can prevent itself from future fluctuation throughout the foreign currency exchange rate by signing this agreement. This contract mission is to protect any foreign exchange position from a loss on a specific transaction. While for the currency option, this method will give company the right but not the obligation to buy or sell a currency at a specific rate on or before specific date. Once the contract maturity date arrives, the company is not obligated to perform the transaction. The investor should exercise the option and benefit from the agreement if the option exchange rate was much more favorable. And if somehow the spot market become less favorable, the investor will let the option mature with less than trade in the spot market. The corporation will have to pay an option premium in order to have this flexibility. That's all for me. For the next slide, I will pass to my friend, and thank you for their time.
Firstly, I will tell about foreign exchange forward contract. Forward contracts are buy now and pay later products which enable us to essentially fix an exchange rate at a set date in the future, and it often leads 12 to 24 months ahead. It also involves two parties, and one party agrees to buy currency at the active future date, and it's known as taking the long position, and the other party agrees to sell the currency at the same time, and it's known as the take the short position. And it has a few advantages of forward contract. First, it allows the business to lock in an exchange rate for a trade that will occur at a future pre-agreed date. Second, choose a rate which suits the business that will allow us to buy and sell in the future at a known rate. And last advantage is manage and budget cash flow without worrying about foreign exchange volatility. And it also has the advantage. First, it is a high risk because the deposit is often required on the commencement of the transaction. And second is the forward rate that is quoted is often given as a premium to the spot rate, and the ability of a forward contract is also based on a demand. Now I will explain about foreign exchange option. And foreign exchange option provide us with the right to, but not the obligation to buy or sell currency at a specified rate on a specified future date. An option commands 100% protection provided by a forward foreign exchange contract with the flexibility of benefiting from improvement in the foreign exchange market. There are 5 basic terminology for foreign exchange option. First, premium, which is the upfront cost of purchasing a current exchange option. Second is strike price. The strike price is the price at which the option holder has the right to buy or sell a currency. Next is expiry date, which is the third expiry date is the last date on which the right attached to an option may be exercised. Next is exercise, which is the act of the option buyer notifying the seller that they intend to deliver on the option contract. And last for basic terminology is delivery date, which is the date when the currency action will take place if the option is exercised. And there are two types of currency action option contract. First is a call option, which is this give the holder the right but not the obligation to purchase a specified currency at a pre-arranged rate up to the expiration date. And the second type is a put option. This put option is give the holder the right but not the obligation to sell the specified currency at a pre-arranged rate up to the expiration date. And the forex action option also can be classified based on the timing for the exercise. First is European option, and it can only be exercised at the end of the agreed tenure or at maturity. And the second is American option, which is it can be exercised anytime during the life of the contract. Besides that, there are few advantages and disadvantages of option contract. First advantages of option contract is provides protection on 100% of our exposure, and the second is allow us to benefit in full from favorable currency move. While the disadvantages of option contract is premium is payable. Now we can see the example of an option currency action contract. For example, a UK-based company imports materials from the US and needs to pay a supplier $500,000 in 6 months' time. The forward rate for 6 months is 1.33 and looking to protect 1.325. The UK-based company would like to benefit from favorable exchange rate while having 100 protection against adverse market movement, and it is willing to pay a premium for this. And there will be a two scenario that we can see from here. First is when British pound and US dollar weaken at maturity, the exchange rate is 1.25 and they are entitled to buy the full $500,000 at 1.325. And the second scenario is when British pound and USD strengthen at the maturity, the exchange rate is 1.4575 and it let the currency option expire and simply buy $500,000 at the market rate of 1.4575 and thus benefiting the 10% improvement in the foreign exchange rate. Now I will pass the presentation to my other members to explain about the calculation of forward rate.
Assalamualaikum and good evening everyone. My name is MUHAMAD HAIKAL bin ZAINI and my metric number is 270790. Okay, today I would like to talk about my part which is about calculation of forward rate. First of all, let's know about forward rate. Forward rate is an interest rate applicable to any financial transaction that will take place in future. When we are talking about this, we are talking about the guarantee today right now for a loaner investment that's going to occur at some point in the future. Could be 2 years from now or 3 years from now, but we are going to lock in this rate today. You can see the formula that was given in this slide and the symbol also given in this slide for is your calculation. The formula for forward rate is 1 plus S1 power N1 then divide with 1 plus S2 power N2. After you get the answer, then power with 1 divide 1 N1 minus N2, then only minus 1. Based on the formula, S1 is spot rate until a further future date. S2 is a spot rate until a closer future date, and 1 is number of year until a further future date, and N2 is number of years until a closer future. Okay, for the next slide, now let me illustrate an example for computation forward rate. The step also given for a calculation of forward rate. Firstly, you may determine the spot rate until the further future date for buying or selling the security, and it is denoted by S1. Also, compute the number of the year till the further future date, and it is denoted by N1. And next, you may determine the spot rate until the closer future date for selling or buying the same security, and it is denoted by S2. Then compute the number of the year till the closer future date, and it is denoted by N2. And lastly, do the calculation of forward rate for N1 minus N2, number of years after N2, and number of years is shown. Then we can apply the formula to this question. A company PQR Ltd, which has issued bonds recently to raise money for its upcoming project to be completed in the next 2 years. The bond issued, which 1 year maturity, have offered a 6.5% return on investment, while the bonds which 2 years maturity have offered a 7.5% return on investment. Based on given data, calculate the 1 year rate 1 year from now. Okay, so that's spot rate for 2 years as equal to 7.5%. Then spot rate for 1 year as 2 equal 6.5%. Number of year for second bond is 2, while number of year for the first bond is 1. After you insert the formula, then you will get the 1 year forward rate 1.5%. Since we are able to calculate the 1 year forward rate, it is wise for us to compare this bond with other type of bond to see which bond offer highest probable profit by looking at the forward rate, so that we can avoid from getting lost. Okay, that's all from me. Next, I will pass to the next presenter. Thank you.
Now let us see an example of application forward contract in international trade. First of all, ABC factory in Edinburgh is looking to buy motorbikes from Taiwan. The business meet with the supplier and agrees to pay $500,000 in 3 months from now. The current Great Britain pound and USD exchange rate at that time is equal to 1 Great British pound equal to $1.32. ABC factory therefore expect to pay $378,788 Great British pound for that equipment. In 3 months' time, 1 British pound is equal to $1.25. So there will be a 2 scenario where that we can see from here. The first scenario is when that ABC factory did not use a forward contract. After 3 months, ABC factory ready to buy the machine from Taiwan, but the exchange rate had changed from 1 Great British pound equal to $1.32 to 1 Great British pound to $1.25. This caused an ABC factory to lose about 21,212 Great British pound, because ABC factory need to pay 400,000 compared to the budget has been set, which is 378,788 Great British pound. And the second scenario is that the ABC factory use forward contract. Although the exchange rate has changed from 1 Great British pound to equal to 1.32 US dollar to 1 British pound to 1.25 US dollar, still the factory need to pay only 378,788 British pound because the factory and the Taiwan has entered the forward contract and agreed to buy the motorbikes at the price of $500,000, which need around 378,788 British pound to convert to 500,000 US dollar. So here it shows that the ABC company managed to avert loss 21,212 British pounds since it pays same as the amount budgeted. In conclusion, we can see that forward contract has saved ABC factory avert loss. Now I will pass to my other member to give a conclusion about our topic.
So in conclusion, we can see that foreign exchange market provide an environment with low transaction costs compared to other market, but it also face many risks. Okay, a person without any knowledge regarding foreign exchange market should not enter this field because it will lead to a greater loss. So if they really interested to enter in foreign exchange market, they can conduct or to have a meeting with a knowledgeable finance individual. Okay, that's all from our presentation. Thank you for listening our presentation and sorry for any inappropriate action during the presentation.